Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance.
That was awful. Hello.
Hello, who are you?
I'm Gabby. Who are
Hi,
you?
Gabby. I'm Goose.
Hi, Dr.
Nice.
Goose.
Hi, everybody.
Oh gosh, what are we doing here? What are we doing?
We're getting big. We're making them gains. We're making them gains
Yes.
today. What are we talking about today, Gabby?
Inflationary gains?
Inflationary gains.
That's not even close to good.
No, that was a little bit rough around the edges. Okay, right. So on today's episode, we talk about inflation. We talk about what it is, why it's caused. What do we cover today, Gabby? Because I did a lot of talk. I don't even know what we talked about. What do we cover?
So we talked about inflation from the angle of like a lot of people seem to have a bit of fear and uncertainty of inflation and its effect on the economy and the effect on your like personal investment strategy. Because I think people think of like they see the current environment and they see like prices going up and they hear the word inflation and they like if you don't quite understand it, it can seem a little intimidating and it can kind of pause your action, pause you in your spot because you just don't understand it. So we just wanted to kind of pull that apart. What it is, why it's actually a good thing and we actually need it in the economy and to keep cash moving through the system, keep prices going up, keep everything moving and lubricated, I suppose. And obviously we talked about obviously when things go badly as well, when there's probably too much inflation or if there's deflation as well. So I think it's important for people to understand so that, you know, we're here to bring people the tools and the understanding of all of these pieces and how they work together. So this is just another important piece of understanding this whole game.
100%. So if you have been wondering, what the hell is inflation? How does it work? What causes it? What does it mean for me? How can I use this to my advantage and all of that kind of stuff? Then I'm confident you're going to be able to extract at least some value out of the absolute ramblings. I really waffled a lot today, Gabby. So
it's good. It was from the spirit.
Okay, good. I'm glad that my spirit is full of inflation. Yep. So, all right, guys, without any further ado, let's get stuck into it. And of course, if you like this, make sure you like, rate, review, share, give it to a friend, family member, or loved one. And of course, if you need help to build a prolific and powerful property portfolio, then don't hesitate to reach out to us. Just head to dash.com.au. We'll see you on the inside.
Bye. I mean, hi.
See ya. Hey guys, welcome back to the Investor Lab. Hey Gabby.
Hello, Goose.
Hey, how are you?
I'm well. How are you?
I'm well. Why are you whispering? You know what's exciting? Sorry, I didn't wait for the answer. Why are you whispering?
Wait for the answer. Well, I'm coming to you live from our wardrobe. Well, okay, not really a wardrobe. Also, not really live, but I had to say it. I'm in the multi-purpose room of Goose and Gabby's apartment.
Yeah. So
felt like whispering during that as well. So
yeah, it's a little creepy. For those listening, they may notice a bit of an audio difference because we've just reset up for home recording. Looks like we're going to be locked down for a little while. I've got my lockdown beard happening.
You do.
I'm turning into a lion. I've got a forest of hair everywhere going on. Yeah.
Well, what you just said before we hit record was, I think I'm going to shave my head. And then you went, let's record. So do we need to talk about that while we're recording? How are you feeling? Are you okay?
Yeah, no, I'm good. We just, for those listening, we just had some pancakes. So we just made some vegan protein pancakes.
Nobody cares.
No, but it's interesting. We've got lockdown, we've got pancakes. Yes. But what would have been really good, right? The pancakes were tasty enough, but what would have been really, really good is if they inflated a little bit more, if they were a little fluffier.
Nobody else gets that yet, but I get it.
Do you want to let everyone in on the joke?
I wonder what the topic is today.
Today we're going to be talking about pancakes and inflation.
Yes.
No, we're going to be talking about inflation today, Gabby, aren't we?
We are. Not pancakes. Sorry, guys. Sorry.
No one cares about the pancakes, but a lot of people care about inflation. So what are we going to be talking about today, Gabby? What's the go with inflation? Where do you want to start with this topic?
Well, to be transparent, I know very little about inflation, but I know that it's something that massively on a huge macro scale in the economy is a huge kind of piece in the way that the whole machine works, and obviously how it affects property. And so you know significantly more about inflation than I do. So, and I know that you've brought it up recently that it's something that people kind of have a bit of fear about or have a bit of trepidation about, just the word inflation, but they don't really understand what it means and how it affects their decisions in property. So I just thought it would be good to chat about.
I think it's a really great topic for us to be chatting about. I think it's awesome. So, given that we have different levels of knowledge about it, what I think would be really good is for you to try and mine some data.
Nugs.
Mine some nugs out of my scone, and then why don't we go from there? So why don't we do that? Because I think inflation right now, I think it is something that people need to be. Well, a lot of people are thinking about it, right? And there are a lot of people are questioning, should they buy property? What happens in inflation? Does it make sense to buy property in an inflationary environment? Is there going to be inflation? Is inflation bad? Is it good? I think there's a lot of stuff that I believe that nothing is either good or nothing is good or bad. Everything just is, right? Mm-hmm. And inflation is no different. And I think it's a really valuable topic for us to be digging into. So, Gabby, where do you want to start?
Can you give a bit of context of why, what are people's main concerns about inflation? Are people just not wanting to invest right now because of inflation?
Well, I just think that people are unsure, right? Right. People are unsure because they don't get it, right? Because people don't get it. They don't understand it, right? And in very simple terms, inflation is when prices go up, pretty simple, right? It's the simplest way to think about it. And in fact, a much more simple and easy to understand definition is when the cost, right? When the cost of goods and services increases without any value being added. That's the difference, right? Mm-hmm. Because if a loaf of bread costs more the next day than it did today, but the next day it's covered in gold, right? Well, that's got value added, right? So therefore, okay, well, the cost has gone up. Fair enough. Cool. All good. Mm-hmm. But when the cost of bread goes up, but it's the same bread, exactly the same bread that you could have bought the day before, then the price is inflated, right? And inflation's happening all the time. It's been happening for ages, which is why in 1970, the cost of a loaf of bread was 21 cents in Australia. 21 cents for a loaf of bread in 1970. And then now the average cost for a loaf of bread is $2.35. So that's inflation there, right? So inflation happens all the time. But we also haven't had a lot of inflation for the last roughly a decade, right? Don't quote me on any of this kind of stuff. I'm not an economist, right? So maybe just I don't think it matters anyway, but it's roughly about a decade or so, could even be a bit longer, that there's been a low inflation environment, because what the government wants ideally is about 2 to 3% inflation, right, every year. And the thing is, we've had less than that for the last decade or so. So in real terms, prices haven't really been rising. And that's had some downsides to the economy. And really what the government wants is they want to see a continuously growing economy. So that's just on that, why do governments want inflation? Why do they set up the system to make that happen? it's because it stimulates more productivity within the economy, right? And so a lot of people would think, like, why the hell would we want things to be more expensive, right? So in order to give that some context, we have to explore the paradox of thrift, which was a Keynesian philosophy, right? So John Maynard Keynes, who back in the mid part of the last century, he kind of defined modern economic theory, right? And so a lot of people say the system that we operate under is commonly called Keynesian economics, or Keynesian monetary theory. Now, under Keynesian theory, the problem, what you want consistently is you want to have a continuously inflating economy, typically at around about 2 to 3%, right? Because what happens if you have zero inflation, so not even deflation, just zero inflation, right? What happens is that production gets more efficient, because as people in businesses and countries grow and learn and get to do things better and better and better, things become more efficient, right? And as they become more efficient, the cost of goods goes down. So in a real sense, the loaf of bread would cost less the next day and not more, or actually not even the same amount, because as productivity increases, the cost of production decreases, and therefore the cost of goods and services decrease as well, right? Which may seem like a really, really good thing, but then you get this problem called the paradox of thrift. And the paradox of thrift says that if the reasonable expectation is that things are going to be cheaper tomorrow or next week than they are today, it encourages people to spend less, right? They're more likely to save their money until they absolutely need something, because they know that whenever they buy it, it's going to be the highest price they're ever going to pay for it. So it actually decreases the impetus for people to spend money on stuff. The problem with that is that also then decreases the demand for things. And then as the demand decreases, that means that production decreases, which means that people lose their jobs, which means that, the whole economy starts to fail because there's less taxes, there's less production happening throughout the economy, GDP starts to go down, and all of this kind of stuff, right? So it's real bad, right? So actually, inflation can actually be a good thing, right? And the way to think about that is, if prices are going up, then it encourages people. Obviously, you don't want hyperinflation. We can talk about that a little bit later in the episode, right? But if prices are going up, if you know that, you can buy, I don't know, a BMW. I don't know how much a BMW costs, right? But let's say you can buy a BMW for 100 grand now, and you know that next year a BMW might be 120 grand. Well, it's like, well, okay, you're getting it now for 100 grand, and it's worth less than it is going to be in the future. That's the general premise, right? So I got a little off track. So that's why governments want inflation, because inflation actually drives demand.
Okay, cool. So it sounds like inflation is actually quite an important piece in the whole ecosystem, right? And it's quite, people on a surface level probably understand that, and they can acknowledge that, okay, it influences it in some way, but haven't fully understood what the impact is or the importance of it as well. Particularly from a benefit perspective, I think people think of inflation as a consumer. You think of inflation and you might think of it as a negative, because you think about, like you said, the price of bread is gradually going up, rather than the idea of how it is actually fueling the whole economic system and how it's actually a good thing.
Yeah, 100%. Yeah, because inflation is so commonly seen as a bad thing. And again, like I said at the start earlier in the episode, it's neither good nor bad. It just is, right? So there are good bits about inflation and there are bad bits about inflation, right? And if you understand inflation, then you can really benefit from inflation. And you could also hedge against inflation, right? So you can understand the upside and the downside and all of that kind of stuff. So that's... And I think that's like, so there's another really interesting thing, right? So let me talk to inflation a little bit more, because one of the reasons it's a big prescient conversation right now is because of quantitative easing, right? And so because the government is printing a lot of money, right, what tends to happen is that the value of that money decreases, right? So I'm talking in very general terms here, right? So I'm just simplifying. There's actually way more complexity to it than this, right? But in very simple terms, if there's more money sloshing around in the economy, right, then it starts to lose its value, and also it's cheaper. Like, so it's cheaper to or it's easier for businesses to employ more people, and more people start to earn more money, and there's more money floating around in the economy, and so people start to spend more, and as people start to spend more, demand starts to increase, and as demand increases, prices increase, and therefore we start to get inflation, right? So that's why people are talking about it right now, because right now there's a bunch of money getting pumped into the economy. Yes, many parts of Australia have just gone into another lockdown and all of that kind of stuff, which is likely to extend the quantitative easing program from the Reserve Bank of Australia. And what that's going to mean is more money is going to be pumping into the economy, right? And what that does is that actually drives up asset prices. So that drives up asset prices. It drives down growth. It actually, funnily enough, it actually decreased the cost of debt, which is a really, really interesting thing as well. And so, oh, that sparked up. You sparked your interest. I saw your face through.
What do you mean? Can you explain, please?
Yeah. So if you borrow $1,000, right? If you borrowed $1,000 today, right, and it was on a 5% interest rate, and then there was 10% inflation, right? The money that you are using to pay back the debt is worth more than the money you borrowed, right? So in real terms, it's costing you less. It's costing you less money, right? So that because what you borrowed is in historical terms, and then what you're paying it back is in future terms. So you're paying it back with more valuable money, right?
Yeah, right.
So it's really good for debtors. So it's actually it's actually really good for the US government, because the US government is the largest single debtor in the world, right? And so when inflation goes up, the cost of their insanely high amounts of national debt actually costs them less, right? Which is good. So just to understand how it works on a super, again, this is super high level without going deep into the economic theory of it, right? But basically, when the government wants to increase inflation, it lowers the cash rate, right? So it lowers interest rates, because what that does is that stimulates more spending, right, and more borrowing, because people borrow money on cheaper interest rates and spend more, and they'll go buy a boat, and they'll buy another house, and they'll take their kids on holidays, and they'll start to spend more. And then what that does is then that drives up inflation, which again is a good thing, because that stimulates more production and more demand in the economy. And that also typically stimulates wages growth, right? So they typically sort of go, unemployment goes down as demand goes up. As demand goes up, production requirements go up, which means more people get employed, which means unemployment rates go down, which means wages go up, which they have to, because they have to be able to compensate for the increased cost of goods and services, cost of living, cost of assets, all of that kind of stuff. Now, the problem comes because it starts to become an exponential flywheel, right? So what happens is that people start spending more, which means that it drives up the cost of goods and services, or cost of assets, which means that people try and get in faster, because they're like, oh my God, house prices are only going up. Oh my God, quick, get in now. And people get FOMO, and then people start to try and spend more. And then it starts to flywheel in the wrong direction, right? And then everything starts to cost an insane amount, right?
So is that what we're starting to see now?
No, we're not. In a real sense, we're not. Like, so yes,
is
there
that
has been
what people are afraid of? Yes.
So people are afraid of hyperinflation, right? Yeah. So hyperinflation is when, for example, if you look at the Weimar Republic in the 1920s, to basically Germany, it got to the point where value of the dollar had decreased relative to its purchasing power, which is to say that what once a loaf of bread might have cost once upon a time $1, and it was then now worth. It actually, the cost of living increased by 1.5 trillion times, right? So
wow.
So if a loaf of bread was $1, it then became $1.5 trillion for a loaf of bread. That's how much inflation increased. So what happened is the cost of the goods and services increased, which actually decreased the value of the dollar relative, because you needed more dollars to buy the same amount of stuff, right? Do you understand that relationship?
Yep.
So therefore, instead of a house costing $1 million, a house might cost $2 million, but it's the same house, right? It's the same house, which just means that your dollar is buying you less, right? So that's the inverse of it. Now, and so what can happen when stuff hyperinflates is it starts to get out of control because the exponentiality of the rising demand and the rising costs and the devaluing of the dollar, it starts to get out of kilter. So there's not many ways to try and tame that beast. And that's a real concern when that happens because it can completely collapse economies. So like in the Weimar Republic, people were wallpapering their house with dollar bills because they were just so worthless. In Zimbabwe, people were walking down the streets with wheelbarrows full of $1 billion notes just to go and buy their groceries. In Venezuela, there was like thieves and stuff that would refuse to steal people's money because it just wasn't even worth them carrying. Like it was ridiculous, right? Mm-hmm. And so this is the impact of hyperinflation. So that's the risk, and that's what people get scared of, right? And they also get scared they're going to miss out. So the opposite is also just as bad. Deflation is probably just as bad as hyperinflation, right?
Why?
So that's probably a topic for a whole nother podcast, but it's the inverse of inflation, right? Mm-hmm. So that means that it might end up getting, just on an extreme case, the $1 million house might and become $500,000, right? So then asset prices start to decrease, and then people's network, and then everyone tries to put all their money in cash, and then people then start to try and spend less because cash is worth more than the things that they buy, and then that stimulates. That's basically the paradox of thrift in action, right? Yeah. So in the inverse of inflation, people don't want to spend any money because money is worth more than the stuff that they can buy, and in an inflationary environment, nobody wants money because money is worth less than the stuff that they can buy, right? So that's the easiest way to think about it. So, in an inflationary environment, if there's high inflation, basically the minute you get money, it's the second that you have it, it starts to devalue, right? It starts to, like, say cash is trash. So as soon as you've got it, you should spend it as fast as possible. Fill up your fuel tank, go and get as many groceries as possible. Like, just get rid of it, because if you can get real things, they're going to be worth more to you than the cash is, right? Deflation is the opposite. So the risk these are the extremities that the economy tends to have to ride within. The typically held belief is that for an established economy, or for a developed economy, should I say, 2% is a good target inflation rate, and for an emerging economy, it's 3%, 3 to 4%. Now, because Australia has not had enough inflation for the last however long, that's why the inflation target is 2 to 3%. But that's all, and that's also why the premise of what the RBA is doing with quantitative easing is they're saying they're going to keep printing money until the unemployment rate is down to 4% or something like that. Because what that will do is then that will create enough demand for labor, that the cost of labor will increase, right? And then wages will start to increase, which means that people can afford to spend more. And so it's a virtuous cycle that goes around. Does that kind of make sense?
Yep. So where we're at right now is they're about to they're gunning for higher inflation at the moment because we haven't had.
They're trying to inflate the economy. Yeah.
Yep. And so I imagine there's a risk there to try and keep it under control, because I would imagine it would get out of control pretty quickly.
Yeah.
In terms of governments.
How do they get it under control?
Yeah.
Yeah, sorry, that was where I was going when I started rambling and going all over the place. Interest rates, right? So the easiest way to control inflation is using interest rate increases, right?
Yeah, you touched on it earlier. So like, when the easiest way that they can bring inflation up is to bring down the cash rate, right? Yep. Can you explain that just in real layman's terms? Like, how does that influence?
As in the cash rate?
Yeah, the cash. Yeah.
Okay, so there's two interest rates.
Yeah, the cash rate and the relationship with interest rates.
Yeah, totally. So there's two interest rates, right, that people need to be aware of, right? So there's the cash rate, which is the rate at which the Reserve Bank of Australia prints money and then says to banks, you can have this money at this interest rate, right? So at the moment, that cash rate is 0.01%, basically zero, right? So what they're saying is, we'll give you the money and you've got to pay it back to us at 0.01% interest. The banks then put a profit margin on it, and then they say, hey, consumer public, general public, because they get the cash wholesale and then they sell it to you retail, right? That's the difference. So the banks get cash at wholesale prices, right? And we get cash at retail prices. That's the general premise. So then let's say your mortgage interest rate is 2%. That means the spread between the cash rate and what the banks are selling you the debt at, that's their margin, basically, right?
Yep.
So the way to keep asset prices under control. So just to kind of go back to the premise of inflation is that cash devalues, but the things you buy increase in value, right? Now, if you buy a depreciating asset like a car, that's not necessarily going to go up in value, or that would not be an example of a good way to spend money in necessarily anyway, right? Full stop. But if you're buying something like commodities, like I don't know, iron ore, for example, or real estate, obviously, these are appreciating assets because they hold intrinsic value. Gold is typically seen as an inflationary hedge as well because it holds its own intrinsic value, right? But if you've got a depreciating asset, something that wears out like a car and goes down in value quicker than inflation is going up. So if the value decreases faster than inflation increases the value of it, you're still going to lose money on it, right? Pretty simple. Now, houses typically don't do that. Houses are a really great inflation hedge. So what governments do in order to throttle business expenditure and also household expenditure is that increase interest rates. So if you've got lower cost of cash, right, then you may be more inclined to I'll get a loan, I'll go get a boat or whatever, right? Because the cost of money is cheap, right? If the cost of money increases, you're going to be thinking more carefully about your household expenses. You're going to be thinking more carefully about household debt levels. You're going to be thinking more carefully about all that kind of stuff, right? And so you're more likely to throttle your spending and save a little bit, right? And the ability for businesses to rapidly expand using debt decreases, and all of this kind of stuff, right? So it starts to slow things down, which is why interest rates typically go up when they're trying to control inflation. So if you get high inflation, interest rates go up. If there's low inflation, then interest rates will go down to try and drive it up, right? So that's the relationship between interest rates and inflation. Not enough inflation, cash rate goes down, interest rates go down. That stimulates more demand. That stimulates more the velocity of money, which is actually the most important thing. So the speed at which money moves through the economy is one of the greatest indicators of economic health, right? So just in the same way that blood circulating around your system, if blood is different colors. Did you know that?
No.
So blood actually turns different colors. If you've got a high level of circulation and if your blood is pumping freely and it's moving quickly, your blood will be a bright, bright red. If your blood is circulating slowly, it turns quite dark because it starts to stagnate, right? So the circulation of money through the economy is one of the biggest indicators of cardiovascular health for the economy, right? And so what they want is money moving quickly. But if they need to slow it down, right, if it's moving a little too quickly, if people are starting to get heart palpitations and stuff like that, interest rates go up, slow the velocity of money, etc. Do you have any questions on that?
I'm just thinking about why, we talk a lot about a bloat and cut type of analogy with so many things in the world. And it seems like this is another one where you bloat inflation and then you kind of cut it, and it's a back and forth, right, where they seem to consistently move to strong levels of inflation and then kind of mute it a bit, don't go into deflation but bring it down. And then it's why do you may not know this, but why does it not just find an equilibrium and then in an ideal world it would. In an ideal world it would, right? So here's the thing. The optimal, everything in the universe operates on an oscillating frequency basis, right? Everything, right? So the frequency at which atoms vibrate, sound, everything, it's on an oscillating frequency. And what that is basically is to say that if there's a static midline, right, there's variations where whatever it is, whether it be the frequency of an atom or whether it be a sound wave or whether it be the economy or whatever, will vary from that baseline, that midpoint up
all right, but it'll go above the line, right? And it'll go too far above the line, and then it'll need to correct, and then it'll go below the line, and then it'll go too far below the line, and then it'll need to correct, and then it'll go. And the whole time, all it is trying to do is get to the baseline, right? Now, I have a belief that if you can get anything to vibrate on the exact, if you can reduce the frequency, it operates in perfect harmony, right? So that's where like that is perfect harmony, right? And so typically what happens in any environment, right, is let's say demand increases, right? For let's say you're in a factory, right? The demand increase, you're a soccer ball factory, and demand increases for soccer balls, and it's like, oh my God, we've had 10,000 orders for soccer balls, but we only have 100 in stock. Quick, everyone, we need to make heaps of soccer balls, right? So then everyone starts making soccer balls, and oh my God, make more soccer balls, and all the orders keep coming in, and then all of a sudden all the orders stop, but there's a latency between when the orders stop and when the production slows down, and then so all of a sudden you end up with a glut of soccer balls, and you're like, oh my God, we've got too many soccer balls. Quick, everyone stop making soccer balls, right? And let's try. So what happens is you
sell them, just get rid of them. Don't try.
Get rid of them. Just get rid of them.
Cover costs. Don't try and make a profit. Yep.
So everything operates, everything oscillates, right? The goal of any system, right, is to try and reduce the oscillation to a normalized frequency range, right? And so the normalized frequency range should be as close to the baseline as is practicable within whatever system, and that finds perfect harmony, right? And so in an ideal world, that oscillating frequency for inflation would be 2%. So if, for example, the oscillating range was 1.5 to 2.5%, and if it constantly just did that the whole time, bingo, we're good, right? The problem is it hasn't, right? And so what happens is you need to try and move it in one direction or another. And as you do that, you've got to try and put brakes on either side. And then the goal is to try and get it just within the line, basically. Yep.
Cool. Okay. That makes sense.
Yeah. So that's what they're trying to do. They're trying to inflate it because it's too low and it hasn't gone. Yeah. Ideally, they would like to cap that inflation at like 3% until we find normalization, and then get it under control. And it is totally doable. It's not like it's an uncontrollable beast, but there are so many different levers that happen on a global economic level, that influence these kind of things, because it's not always within one government's control. Because you might, the RBA or the government might put in policies in place based on the things that are in our petri dish of Australia, and they're like, okay, within this petri dish, here are all of the levers that we can pull, right? I don't know, we can increase taxes, we can decrease the cost of borrowing, we can pump money into infrastructure projects, we can do this and this and that. But then, I don't know, maybe China stops importing iron ore. Yeah. Well, we can't tell China to keep importing the iron ore, right? So then all of a sudden, that then has a massive economic impact, and there's more levers that need to be pulled. So in a globalized economy, there are loads of other factors which dictate a lot of the comings and goings of what we need to think about here.
Yeah, cool. I like it because there's it's a lot of different layers, right? There's so many layers where you can think in your little local level, and then you can think about LGA level, and then you can think about the state level, and then you think about national, and then you think about international economies. And it's the same, if you think about a real estate strategy, it's you could think about this strategy works for me right now, considering my situation, looking at it just zoomed in, but then it's okay, actually the value of cash changes. So that strategy actually is not really the best strategy in the current economy.
Yeah, 100%.
That makes sense.
Yeah. And I think the best illustration of that is to talk about shares, which we often do on this little podcast of ours to give a comparison. Yeah. So the interesting thing with shares is that, we've often talked about negatively geared companies, or they're typically called growth companies, right? So Facebook, Amazon, Netflix, these Uber, all that kind of stuff. These are companies that are growth based, and they typically are low cash flow or no cash flow, right? Depends, right? Now, the reason in a low inflation environment that they go really, really well is because typically the cost of money is cheaper, right? So as the value increases faster than the cost of debt, right? Now, the downside, of course, is that in a high inflationary environment, the inverse is also true. So the cost of debt starts to increase, and cash starts to devalue. So basically, the inverse becomes true, because you want to then buy assets which are actually going to produce cash flow and also grow in value, right? Mm-hmm. because of the variance in the cost of debt. So in real terms, for like property investors, one of the best things you can do is to buy property in an inflationary environment, right? So if we're in a deflationary environment, you're better off just keeping all your money in cash, right? But if you think that that inflation is going to happen, and the thing is, inflation actually is happening right now, just to be clear. So what's happening right now is we've had a heap of inflation, but I think it's an inflationary blip, right? So, and there's different causes of inflation too. So we could probably talk about that for a minute. But basically, yeah, if you're in a position where you're in an inflationary environment, or you're entering into to an inflationary period, or you want to hedge against inflation and benefit from it, then you're much better off to buy assets. And in fact, if you're going to buy assets, you're much better off to buy income producing assets, because the likelihood is that interest rates are going to go up to throttle the economy. So if your current interest rate is 3%, right? But then if in 5 years that interest rate goes up to 6%, then you're going to want to make sure that you've got assets which are going to be able to hedge against the higher cost of that debt, right? So therefore, you want income producing assets that also grow, right? Because there's three types of assets, right? There are income assets, growth assets, and then there are basically value assets or balanced assets, right? And so to use the two extremes, an income asset could be, if you just base it purely on a yield basis, could be, I don't know, some tiny house or some house in some tiny country town where the yield is like 11% or something like that, right? Mm-hmm. The downside of that is that you're not going to get the maximum benefit of inflation and growth because of the environment that it's in. Now, but if the interest rates go up, yes, you'll be able to afford the additional interest rates, but essentially, like, you're not going to get much of the benefit from inflation. You're better off having your money elsewhere. Inversely, if you were to buy something that was negatively geared, yes, the asset value would increase significantly because of the exponential, like the magnification effect, I guess, of inflation. However, if interest rates go up, the likelihood of you being able to afford to continue to hold that is going to be low, right? So you're going to be put in a position where you might not be able to hold the asset. Mm-hmm. Now, in a balanced scenario, you're going to have something that grows and also produces surplus cash flow. That's in a business and a real estate sense, and then that's going to be your hedge against increasing interest rates. So that's one way to think about it. Now back to sorry, I'm on a little bit of a roll here, but
go for it.
There's the reason that I think that we're currently only in an inflationary blip at the moment is because of the cause of the inflation. So the cause of the inflation at the moment is supply chain breakdown, right? So what causes inflation is a cost in the production of goods and services, basically, right? Mm-hmm. And so at the moment, one of the biggest problems is imports and exports have basically, had been shut down or slowed down, or there's been breaks in the supply chain because of COVID, right? Which has meant that the cost of goods has gone up. So in a building sense, the cost of raw materials, timber and stuff, has gone up, and therefore the cost of building a house has gone up, mm-hmm. Like massively, insanely so, right? So now it costs too much to, but now it's costs more to build a house than the house is going to be worth, which is just mental, right? Who the hell wants that, right? So the thing is, though, that as soon as the supply chain issues have been fixed and corrected, which could happen when there's, more vaccine uptake worldwide, or whatever the case may be. But as we start to move through the back end of the COVID situation, we'll likely see supply chains being reestablished, and the actual supply has not diminished. Supply is still there. The raw materials are still there. They're not being distributed or turn from raw materials into distributable materials in a short enough time frame. So as soon as we can ramp up production, the supply chain issues will be sorted out, which will bring the cost of goods back down a bit. So I just think we're right now in a bit of a blip. I don't think it's anything to be concerned about. A lot of people are concerned about it because they're like, oh my God. There's, the cost of goods is increasing, but I think it's just a blip right now. And I think that's also, sorry, I just finished on that because I think that's also evidenced by the fact that the government isn't ramping up interest rates right now. So
yeah, because it seems like people are. Sorry, I asked the question earlier about like, is that kind of what's happening right now? It's like, are we at the start of like, are we in a highly inflationary environment? And you said no. So it's like, it seems like people are responding with that FOMO as though we are in a super hyperinflationary environment, but it's not an organic inflationary period. It's just that blip based on the supply chain, as you just explained.
Yeah, 100%. And so you can definitely see it in parts of Sydney. Interesting thing about Sydney is everyone thinks that all the prices have been going up everywhere, but they haven't. Some suburbs in Sydney have actually lost money over the last 12 months. So it's not like all house prices are going up everywhere. But what's been happening to drive up house prices in some locations in Sydney, for example, just using Sydney as an example, is that people have been getting FOMO, right? And they've been worried that they're going to miss out. And that's been artificially inflating prices, right? So inflation happens in a few different ways. It's not always some big economic movement. It can just be the prices are back to what I said at the start. Is when prices increase with no value added, right? Mm-hmm. So there's been no value added to change the intrinsic value, but the cost goes up. That's inflation. Inflation can be caused by increased demand, increased cost of production, increased all kinds of different stuff. And sometimes the demand is artificial because people have psychological impacts where they believe something and therefore act on a herd basis, which can inflate prices, which typically results in a flattening of prices afterwards because people go, oh, hang on a second. How, are we still doing this? Is this still going to keep going up, or where's the balance point? And then it'll revert to the mean eventually, or where there's supply issues where you can't get the stuff. So, and that's simple supply and demand. So if there was no coffee being imported into Australia anymore, well, guess what? The cost of coffee would suddenly skyrocket because there'd be a limited supply of beans. So there's different kind of things at the moment. And a lot of the problem that people face is that they do get FOMO, but it also works two ways because people get fear, full stop. Firstly, they sometimes get fear of missing out, and sometimes they get fear of the unknown. And in both cases, it leads to poor decision making. As I say, I think, and I was saying this during, March, April, May last year when everything was going a little bit wild and people were a little bit like, what's going on? I was like, no, this is good because what's going to happen is we're about to start a huge property boom that's going to kick off for the next five to 7 years, right? And now that's going to be driven by a variety of different factors, but also one of those factors is going to be the quantitative easing and some inflation. So it can be a good thing if you understand it, but it's good to not get caught up in it. And it's also not good to not get afraid of it because, everything has a pro and a con. And if we can understand it, we can work out a benefit.
Awesome.
Cool. Any other questions?
No, I was just thinking I want to try and get something actionable, or like what, if someone's listening and they're like on the fence about investing in real estate right now. They might have been wanting to for a while, but they've got a bit of this fear that we're talking about of inflation. Like, what would you say to them right now?
Well, it's pretty simple, right? So the easiest way to think about it is if you were going to buy a house now, but you're not sure, just think if you could go back to 1970 and buy a house then, would you? And the answer to that from everyone should be yes, right? Because the cost of a house in 1970 was probably about, I don't know, 100 grand or 80 grand or something, and now it's be 800 grand, right? So inflation is your friend in property investing, and so what people need to be cautious of is not inflation, but what people need to be cautious of is interest rate rises, which again are not necessarily a bad thing. They're just a thing. Obviously it's better for property investors when interest rates are lower because they can borrow more money and get more cash flow. And of course, right? But the question shouldn't be, should I not invest because we're about to get inflation? It should be, how should I invest so that I can get the maximum benefit from inflation, but I can also manage my risk against interest rate rises? That should be the real question that people are asking themselves.
Sweet. Great.
Awesome.
Cool.
All right, Gabby. Well, I'm interested to know, because we started this episode when you say that you didn't really understand inflation. And I'm interested to know, do you feel like you understand it a little bit better now? What are your kind of biggest takeaways out of this?
No, I definitely do. I think it's interesting to think about it's all just a big machine and all these different cogs that flow into each other. But it's also like, we know that prices go up and down, and we know that, you know, part of being in property specifically is that you want to experience growth in your asset value. And so inflation is actually like a really significant factor in making sure that happens. And so it's important to understand that and not be afraid of this term inflation, because you think about costs going up, but it's like, it actually brings the benefit that you want from this strategy that you're doing. Which I think, I think it's important for people to understand.
Yeah. What my favorite part of this discussion was actually the paradox of thrift. I think that's fascinating.
Yeah.
I think it's a really fascinating thing to think about, because it seems counterintuitive, right? That prices going up should be a good thing. But only when you consider the inverse do you realize how bad it would be if the prices of everything went down, right? And it's truly fascinating to understand why we need to try as best we can to continue to stimulate endless growth. Now, is endless growth even possible? Like, I don't know. Like, can the economy grow forever? Like, that's... I don't know. And I don't know the answer to that, but that's the premise of what we need to do. That's the premise of the current economic theory, which we operate in within. So, yeah. Anyway, I hope this episode's been valuable for you guys, the listeners. If you've enjoyed it, let us know, and we will see you on the next episode.
Awesome. Thanks.
See you guys.
Bye.